Okay, good morning, everybody, and welcome to the Daily Energy Markets Podcast, Thursday, December the 8th. That was the day when I was a kid that everybody went shopping. There used to be one day, December 8th in Ireland, you went shopping and that was it. Done, dusted. Now it's a 3-month affair. Who knows? I suppose it's good for the economy. Oil prices, however, a little bit of an upward movement this morning on Brent after what has been a series of somewhat counterintuitive declines. China opens, the Russian oil is disrupted. You would think all bullish sentiments, but yet oil price falling. Let's go to Mike McGlone, senior commodity strategist, Bloomberg Intelligence, who has been telling us for some time that the downward draft on oil prices is pretty locked in. It's only a matter of when, not if. Mike, your thoughts on the market direction this week?
Yes, I guess I'm one of the few that's not surprised, Sean. To me, the giant swinging pendulum has just come back to its mean meeting in mode, its most comfortable price. WTI at $72 a barrel is actually the average price since 2006. Pretty close. This is the first time it traded there. It got way too expensive above 100. And the key risk is it gets cheap below 50. That's just the normal pendulum swinging factor of crude oil. And then you have to focus on the noise in between. So I think the key factor is right now we're at a pretty good clearing price. I alluded as no surprise. People forget that what really drives crude oil, remember, it's positions, it's futures, and it's towards the end of the year. We have been seeing a pretty orderly liquidation of the stock market. It's been pretty significant, and people flowing into bonds, getting out of commodities. That's the macro. And I think right now the key thing to think about is for next year is what stops WTI crude oil from getting too cheap. This year it got too expensive. We saw what happened with that. We've seen a global economy heading towards recession. That's the view from Bloomberg economics team. Certainly in the US and Europe, China's a little more dicey. And then the hopium for demand coming back out of China, yet that's been kind of trickling down well before COVID. So I see WTI maybe hitting a low next year around 50. I don't think it gets much above 90. And the key thing to think about here, is I can leave you with, is if commodities continue to advance, central banks, including the Fed, are more likely to continue to ease. This is the lose-lose of commodities. We're just back at a clearing price. We kind of followed copper. And there's a few commodities that are still expensive. They still have that war premium in the price, and that's mostly the grains, and that's corn. Corn, I think, is still a bit of a war premium. It's more likely to probably drop.
Neil Atkinson, former head of oil markets division at the IEA. Neil, your thoughts? We're seeing, we still have these bullish factors mentioned. China finally reopening. We've got the Russian disruption. We've got U.S. inventories at near, 30, 40-year lows. Global idle capacity still very tight. And yet the ball is still dropping. Your thoughts?
Well, in your introduction, you talked about bullish factors, the implementation of the sanctions on Russia, the price cap proposal, China coming back. Well, yes, on the face of it, they look to be bullish, but I don't think in either case we're going to see a dramatic change too quickly. In the case of China demand, the signals are still rather mixed. It doesn't look as if China is going to go back to being the Wild West, where just everybody can let it all hang out and do everything that they want. I think there are still going to be restrictions in China. There may well be short, sharp reintroductions of limitations in China if cases take off. So I think the jury's still out on how strong any recovery in Chinese oil demand is going to be. And on the supply side, as far as Russia is concerned, it's not entirely clear yet how much oil production or oil exports more particularly will actually slump in Russia. And the jury's still out on that, and it's still a little clear. So the market is, as Mike was suggesting earlier on, has been sort of ebbing downwards in recent weeks, and I think that's probably entirely reasonable. But the war is still going on. We can still get escalations which could lead to a greater disruption from Russia. So I wouldn't go so far as to say that we're not going to see higher prices in 2023. But I think I agree on the whole with Mike's analysis that the likelihood is that prices are going to remain, crude prices are going to remain much closer to where we are now, ticking slightly downwards. But just finally here, and I realize I'm talking a little too long here, we're talking about crude prices, and that's very, very important. But let's not forget product prices, because that is what really matters to consumers in the end. And the pressures on product prices from strains in refining capacity still remain an important factor we should keep a close eye on.
And tanker rates, of course, are through the roof. Let's go to Mehmet Ogucu, Group CEO, Global Resources Partnership, Chairman of the London Energy Club. Mehmet, you were just in Brussels. What's the mood there vis-a-vis the price cap, EU posture vis-a-vis all things Russian invasion of Ukraine?
Well, actually, there's so much confusion in Brussels still. Whoever you talk, you get different answers. But clearly, the sanctions, nobody is challenging except perhaps Hungary to a certain extent. On the oil price cap, they joined, of course, all other G7 countries, and they are going to implement it quite strictly, it seems. But the cap price, $60, it was quite difficult to reach. And I don't think it's going to have a much impact on oil markets because Russians are already able to sell at $52 with a huge discount to countries like China and India. And the real challenge was going to be about the shipping and the insurance, where the Russians are bringing their old fleet of tankers, as well as their own insurance schemes. I don't know how it's going to work. There was an added challenge when I was there that the Turkey slowed down the passage of oil tankers through the Bosphorus. I think as of now, almost 20 oil tankers are waiting on the Black Sea.
And how should we interpret that from a Turkey point of view? Is Turkey facilitating a more muscular interpretation of the price cap and the insurance, which is the more sort of relevant sort of consequence for shipping?
Well, there was some lack of clarity on how Turkey should be dealing with these tankers, because from the Russian port of Novorossiysk, Kazakh crude as well as the Russian crude are coming through the Bosphorus, and Turkey didn't know how to act on that because it didn't want to be on the wrong side of enforcement, then face the circumstances, consequences of that. Therefore, there was a telephone diplomacy yesterday, I think, with the US Treasury, between Turkish Foreign Ministry and US Treasury, and then US gave the green light saying that there is no need for additional checks on the Bosphorus for insurance and shipping purposes. I think the situation will be relaxed as of today, I understand, because Turkey, as I said, didn't want to be on the wrong side. That in Brussels also, there was a lot of discussion that we had about the natural gas. And this winter is not going to be as bad as we thought, because the stock levels are not bad. And also the LNG facilities are quickly being constructed, especially an FSRU in Germany. And there will be additional 5 or 6 receiving terminals, including FSRUs. And I think Germany is also receiving LNG now directly from Belgium, where dependence on Russia is very low. And there is a project for LNG to be transformed through pipelines to Germany from Italy, as well as Spain, where there's a huge capacity. But the real trouble, they say, is going to be in 2023 winter. And there is so much talk about hydrogen, renewables, and energy savings, but I don't think that it is going to be. I mean, they say that Russia will be producing around 50 million tons of hydrogen, which is equivalent to 155 BCM of natural gas, which is almost what EU is importing right now. So it is quite difficult to cut Russia out of the picture, but right now the intention is to have a Russia-free energy supply architecture in Europe. And what's happening in China, recession is a big
whether
fear
by choice or design, the Europeans will be without Russian energy. As the pipelines continue, although slowly, to be built, more gas pipelines from Russia to China. Mike, looking at the US, I mean, when we think about the softening oil price, obviously the demand destruction and demand erosion becomes more pronounced than supply concerns. And given that, also, I wanted to get your thoughts on the supply possibilities now with increasing talk of re-engagement with Venezuela. Do you give that much weight going into 23? And also the shale patch, there's increasing signs of greater investment coming back into shale.
Oh, so you see I'm smiling. It's nothing like Isn't there something related to necessity and invention? And it's funny how political can get involved. And that to me is just part of the trees of the forest. When prices get high enough and there's plenty of motivation to bring on supply, it'll come, particularly from the world's largest energy producer, and a little bit of political gerrymandering. But I like to watch the estimates from the Department of Energy, and we're heading towards liquid fuel production new highs from the US, which is going to be well above this peak from 2019, particularly if you include Canada. And that's just, and they have to revise them up. It's fully what you expect. The market is nowhere near priced for recession yet. I mean, the curve is starting to get there. And it's almost the key thing I look at is the macro is the supply always comes on. It's just a matter, and it's like I like to go back to my 1976 social science class with Mr. Strezzo. I did a report on the energy crisis. It was the same thing I hear now, problems with supply. So it's one thing I've become immune to, but the key thing I like to point out is the macro. There is 100% chance from our economic models that we're going to have a recession in the US. And when you get recessions, it's almost always follows a spike in crude oil like we had this year. And it almost always gets very cheap. And we're not cheap right now. We're basically fairly priced. So to me, that's the key thing to look forward to next year. And the question is in the endurance of the recession globally. And I view it's going to be one of the worst we've ever had, particularly because at this stage, particularly you'd have central banks, most notably central bank, the Federal Reserve, easing. Typically, commodities, crude oil don't bottom until about a year and a half after the easing starts. We're still tightening. The next meeting is going to be a tightening. That's how bad I think things are. And I fully expect this pump we had in inflation is going to dump as fast as ever. And then we're going to stay down for an extended period because the markets and humans have learned the lessons of too much liquidity and too much inflation. Commodities is a small part of that. I think copper is a good guide. And I think one of the best performing commodities we're probably going to have next year is gold. And the key thing to point out is gold has typically outperformed crude oil in the long term. And particularly since it bottomed in 2008 and 2009. I think once we get that to that inevitable tilt towards easing, which is just a matter of time, gold takes off. And when it needs to do that, it needs crude oil to stay low. And to me, this is the problem with commodities. They go high, the central banks stay tight. It's just a lose-lose for commodities with the exception of gold.
Neil, we're looking, and we mentioned earlier about the situation in China reopening, but we saw the data come in yesterday. China November crude oil imports hit a 10-month high. The Saudis gave a fairly generous discount on OSPs into Asia. Where do you think Saudi Arabia goes vis-a-vis OPEC Plus as they stand on the sidelines, having just had their meeting last Sunday and watching Brent hold solidly below 80 and perhaps keep moving lower?
Oh, gosh, well, after listening to Mike, I'm beginning to wish I hadn't got out of bed this morning. It's still dark here in Paris for another 45 minutes. And my bed.
The sun will rise. The sun will rise.
Oh, dear, oh dear. Yeah, sorry. I'm not, but I agree with a lot of what he said. Now, as far as the OPEC Plus is concerned, I was one of two analysts who physically showed up in Vienna.
I saw the photograph on LinkedIn. I was like, my goodness, you didn't get the memo, but a good excuse to go to the Christmas markets.
Well, I did get the memo and I ignored it and decided to enjoy Vienna anyway. So anyhow,
yes.
The point about it is that I think they were very sensible to abandon the in-person meeting, the uncertainties over the price cap proposal, the weakening economic outlook, blah, blah, blah. And we've learned over the last couple of years that they can hold virtual meetings virtually whenever they want to do it. And they can make any changes as they see fit at very short notice. And that's fine. Now, as far as Saudi Arabia is concerned, now with Russian oil being locked out of the European Union, locked out of the US to the extent that that matters, and other markets, Saudi Arabia is well aware that Russia is going to, and has already, increased shipments to China and to India. So it's providing competition for the Saudis in two markets which are extremely important to them. So it's vital that Saudi Arabia maintains its market share in China and indeed in India, and they will move commercially to do whatever they think is necessary to ensure they maintain that market share. And the relationship with China is, of course, very important, not just for oil. MBS, of course, is becoming more aggressive on the world stage. He's
And
making
he's hosting
sure.
the president of China today, this week.
Exactly. I was literally about to say that. Yes, indeed. So this is all part of the greater world role for Saudi Arabia as pursued by MBS. But a lot of it has to do with maintaining Saudi Arabia's market share in China and India, which remain two of the very, very few, well, not few, but the two biggest important long-term growth markets for oil demand. And that's, I think, what that is mainly all about.
Mehmet, I wanted to pick up on the China, obviously your experience in China as a former Turkish diplomat there. What my sense about prices continuing to fall despite the reopening of China is the fact that the COVID curtain disguised and blocked a view of the wider economic challenges that China faces. And now with the COVID curtain lifted, they're becoming into view. Your thoughts on the wider challenge for economic recovery in China?
Well, I think we cannot deal with the economic recovery and energy issues in isolation from what's happening politically in China, because Xi Jinping is clamping the opposition and some middle class protesting we have seen in the street because of the COVID restrictions. Now there have been some easing of it, of course, but I think over the medium to long term, there is no doubt that the energy demand and oil demand for this matter as well is going to pick up in China. Recovery is going to start. There will be always ups and downs in the economy because of fragility in certain sectors, high subsidies here and there. But overall, I think the government is in full control. So they are going to make sure.
Sorry, on that point, Mehmet, were you surprised that the government, obviously the government is one man, reacted so quickly to the protests? I mean, in 1 week he was saying this, we're married to this policy. The next, after the protests, they seem to relent quite quickly. Or is that a misreading of the situation?
Well, I think they are becoming very pragmatic because they learned also lessons in Tiananmen, as you remember, back in 1989. At that time, I was in the Tiananmen Square myself as a diplomat. And so they learned lessons. Stability, this word is key to all Chinese leaders in a nation of 1.4 billion. Of course, they have to pay close attention to what happens, not only economy, military stability, but what people want. Now, as the middle class is growing stronger and stronger in China because of the developed economic prosperity over the past 3 decades, Chinese leaders are smart enough to understand that if they don't satisfy the unsatisfied people, especially in the urban areas, there is going to be a bigger political problem. So now I think the political relaxation as well as economic recovery will have to go hand in hand, whatever the instincts of a one-man rule led by Xi Jinping will be. So in that regard, there is smartness. And then also relationship between China, we don't have much time perhaps on that. I think we have to look at China, Central Asia, Turkey, and the European Union. To what extent Central Asia will be leaning towards, whether they will continue to be in the orbit of Russia or China or the West. There is going to be a huge
Well, what do you think yourself? It does look at the moment like they're a little bit lost, with Russia obviously preoccupied with Ukraine and inability to engage and provide economic prosperity to Central Asia.
Well, Russia already lost a great deal of ground in Central Asia, even before the war in Ukraine, because China economically created a huge clout there through soft loans and this Belt and Road Initiative, infrastructure investments. Also, most Central Asian leaders were really scared of what happened in Ukraine, as well as in Georgia, South Ossetia and Abkhazia, plus the annexation of Crimea, and also Putin's remarks about Kazakhstan not being a nation. So huge Russian minority. So there is a concern there, but they don't know where to turn to. They don't trust China either, because they know how they treat the Uyghurs in Xinjiang Uyghur Autonomous Region. And Turkey has pushed this idea of Turkic states organization, like a Commonwealth or Francophone. So it's gaining some strength as well. So there was
some reports. Sorry, but there was some reports in the last few days around the tanker traffic jam on the Bosphorus that the Turks were targeting Kazakhstan shipping.
Well, it wasn't exactly Kazakhstan shipping. As we know, Novorossiysk is the place where some Russian as well as the Kazakh crude are coming. And
Right.
so they didn't know whose crude oil it is in terms
Uh-huh.
of origin. So they had to be extra vigilant so that they will not be subjected to sanctions, blacklisting, or whatever. So they were checking the insurance documents and shipping documents quite attentively, perhaps more royalist than the king himself was, Turkey. And after talking to, I think, US Treasury, the situation has been clarified. Now I think things will be much easier. Also,
the checks in the post. Let's go to the survey question for today, which is sort of picking up on the theme of my comments. Oil prices are falling because China's deeper economic problems are coming to light as COVID curtain is lifted. Everybody was living the COVID lifted, the world will be great again. The hopium, as Mike refers to it. Welcome your views on that, Mike. I wanted to drill down a little bit as we sort of go into the weekend here, and we've had some central bank policymakers already meet. There will be the Fed and others. Where is the Fed now and its rate hiking sort of dot line plot, dot plot, as they call it, and the equity markets? I was reading your note earlier in the week and was really taken by some of the commentary in it. That where do you see these things integrating now? Where's the nexus of them? Obviously the equity markets seem to get way ahead of its skis on the sense that the Fed was pivoting. Your thoughts on that and where it plays out over the coming month, the end of the year?
It's called the transition. People still have the hopium from the last 10 years. The world has changed. The Fed is not there to save you anymore. The key thing is you look at Fed fund futures, it's very simple. It should peak around 5% potentially in the next few months and then start dropping later next year. And that's what the market expects. And to me, that's still the dream, that markets don't force the Fed. As I like to quote Nouri Roubini, the Fed will wimp out. I think the markets will make that happen. That was part of my premise for crude oil. Crude oil had to go down, though the Fed was going to keep tightening, and that's starting to happen. Copper had to go down. That's starting to happen. I think we're in that stage right now. It's human nature. Your average sell-side analyst has not realized yet that the Fed is not there to save you when the stock market drops 20%. And that's the key thing, is we're seeing an orderly liquidation of the stock market. VIX is running around 22%. Typically you need the VIX to peak around 40 to 50%. And you need the market to have about a year and a half after the first ease for a bottom. So we're nowhere near a bottom in the stock market as I see it. And even our stock market analyst at Bloomberg Intelligence, Gina Marta Adams, says at best, the stock market is unchanged in the next 12 months. So to me, that's the key thing to watch. There's a high correlation between crude oil and the equities, and there's an orderly liquidation. And I see most of the world, particularly in this country, see the 2-year note, and they can get 8%, 9% over 2 years and say, no, I'm going to just buy treasuries. And that to me is the massive liquidation that's going to happen. To me, this is part of that massive pendulum swinging to a slow recession and people realizing the stock market might have a peak that might last 10, 13 years. That's what it did last time. This is way overdue. The key thing that's changed in my lifetime, I've never seen this, where you have weaker economic growth, the market going down, and the Fed say they're going to tighten more. So I'm sounding like Nouri Roubini, but this is a fact. The key thing I like to point out is a year ago, most people didn't agree with this. Now we all agree. And the key question is how severe the recession is. In my bias, this is going to be one of the biggest global macroeconomic resets of our lifetimes. And we're going to just finally cut that umbilical cord where we have to, where bad news is good news and good news is bad news. Good news will turn into good news and bad news will turn to bad news because the Fed will not be there to save the market anymore. That to me is a transition. And we're finally going through that.
Neil, we've had Saudi budget data out overnight. The Saudi Arabia, of course, expecting its second straight. Well, they've had their budget surplus this year, quite a significant one, but yet the indications for next year of a surplus, but a smaller one, but would indicate from the sort of back of the envelope calculations that they're looking at a Brent price for 2023 between $78 and $80 on Brent, which is a little bit lower than I thought they might defend. But nonetheless, that's where their budget seems to be placed in order for them to get a balanced budget with a little surplus next year. Your thoughts on that as a target for Saudi Arabia and what it might translate to on energy policy?
Well, I mean, defending $90 or more, I think that would be a fruitless task if all the gloomy macro news turns out to be the case. And they're going to have to be realistic. And to dream of $90, which is allegedly what they've been targeting during 2022, is just not going to happen. So it sounds realistic. I don't know if you said 78 to 80. Then is that?
Yeah, 78 to 80. Yeah.
Well, I mean, who in their right mind, with any experience of oil market analysis, looks to set a target price of a $2 range? I mean, come on, it's just ridiculous.
No, that isn't the target. That's what the calculation roughly would be when you because they don't give you a price on oil. They give you their budget target, and then you have to work it back fiscally.
Yeah, okay. Back to the point, Sean. You're right. I think they are realistically seeing that the market is going to be weaker, potentially weaker in 2023, and they're just having there is a more realistic, unspoken price target, and that will determine their attitudes towards production levels as we move into 2023. And my belief is that OPEC Plus, leaving aside Russia for a moment, but OPEC Plus is going to react flexibly and regularly as we move into 2023 to adjust production as it sees fit. They will micromanage the market as they've been doing since the pandemic started in 2020. They will continue to do that in 2023. I think that's just sensible policy.
And Neil, just to quickly follow up, I didn't get your thoughts, or unless I missed it earlier, on where does the price cap come into play from your perspective? Is it a dead on arrival, or will it be more disruptive than maybe people are expecting?
I don't think it's going to be as disruptive as we were all talking about and writing about when this idea was first cooked up earlier in 2022. There are going to be, obviously, there's going to be leakage and cheating. We're all familiar with the various methodologies as to how that might be achieved. And prices are falling down anyway towards the price cap level. So initially, when people were getting scary and some of the investment banks were talking about $120 a barrel crude, roughly now and going into 2023, a price cap of, I don't know, 65 or 70 would have looked pretty extraordinary. But given where we are in the actual living, breathing market today, it's not so scary. And I think oil will continue to flow in much larger quantities than we might have expected. And quite frankly, although they won't say this, a lot of the people within the G7 are going to be secretly relieved that that is the case.
Mehmet, we give you the last word today. I wanted you to talk a little bit about the story that Saudi Arabia will place $5 billion deposit at Turkey's central bank within days. This has been a story that's been bubbling for some weeks now. Will they, won't they? Finally, it seems within days is the latest quote from the Saudi finance minister. I wanted you to speak to why that's important, and what does that tell you about the geopolitics rebuilding in the region?
Well, already, as you know, Turkey has achieved a recalibrating of its foreign policy vis-a-vis Gulf nations, embrace UAE, which is considered to be an arch enemy, and Saudi Arabia is the same way. With Israel, things are normalizing despite the new coalition government by Netanyahu are coming, which may be a bit hostile, but still both sides express that they want to continue on the path to rapprochement. The same with Sisi, he met during the Qatar World Cup. Therefore, I think geopolitically, there is a new realignment emerging now between Turkey and others on the ways of pragmatic policies. Also, related to Saudi Arabia question, Turkish economic fragility, because Turkey needs fresh funds to be injected into economy in the run-up to the elections coming up in 6 months. And this is a critical life and death matter for Erdogan, that election he wants to win. And without economy being somehow relaxed and people's expectations met, it will be very, very difficult already. And Saudi move is not a big move, actually. $5 billion is not a lot. Turkey was expecting to get some treasury guaranteed loans or sort of perhaps swap arrangement. This didn't work. Instead, they are depositing $5 billion in the Turkish central bank, which can be drawn anytime, like any deposit. And so this is the first step. I was in also Abu Dhabi quite recently. I saw there that there is an intention to invest in Turkey but on tangible assets, not giving any loan or whatever, treasury guaranteed. They want to invest in tangible assets. And the Russians are sending some money to Turkey as well, advance payment for the nuclear power plant in Akkuyu. I think Russians, Saudis, UAE somehow will be helping Erdogan to get around these difficulties in economy so that his re-election might be possible, because Erdogan will do anything possible in order to be re-elected. That's the reason why he's showing so much pragmatism in East Med, in Gulf, in Syria now, in Israel, Egypt. Therefore, I think it's all related to Turkey's economic difficulties and being internationally isolated in the region. Turkey wants to break this. This is what's called pragmatism and opportunism.
So Putin would want Erdogan to be re-elected?
No doubt about that. Because the alternative is a sort of a coalition government consisting of 6 parties. There will be sort of a power vacuum in Ankara, where in these critical times you cannot move anywhere. And I mean, there is not much liking of Erdogan in Turkey and outside, as we know that. But still, the realpolitik, the cold, crude realpolitik, is pushing now Erdogan to be perhaps re-elected. But it's not certain yet. 6 months is a long time to go.
What about the U.S. Position vis-a-vis this geopolitical axis of Riyadh, Turkey, Putin?
I think U.S. should be happy that Turkey is re-engaging in Israel, Egypt, and the Gulf nations. UK is also working a lot to facilitate that, so that Turkey will not be sliding to the hostile camp led by Iran, Russia, and China. So that's a critical moment. I don't know how successful they are, because economically they are not doing anything. That's the reason why Turkey is going everywhere, in every direction: China, Russia, Saudi Arabia, UAE. And so I think the foreign policy, Turkey's reorientation in whatever direction it is, as well as the economic realities on the ground, will determine where Turkey will stand in the next few years ahead of us.
That's quite interesting. Well, let's get the survey result before we wrap off. We'll post on social now. General agreement that China has wider problems to keep an eye on, and probably worth doing so. Thank you, Mike McGlone, as always, checking in from the US, Neil Atkinson from Paris, and Mehmet, of course, from Turkey. Really great to have all your insights, top class. Have a great weekend. We'll be back for one more week before the big Christmas departure, and we look forward to seeing everybody from Sunday, 10:30 UAE time. All the best. Have a great day.